Hello and welcome to the latest edition of bondIT Insights. Today we will share the findings of our latest Scorable AI credit risk indicator report to see how credit risk and downgrade probabilities are developing across sectors. We will also take a brief look at the global economic outlook, which seems rather mixed at the moment. And we will share how the risk of falling angels has developed across the various regions since the previous quarter. Let's dive straight in. As we look at the global economy in the year ahead, we see a rather mixed picture. The IMF has just revised its economic growth forecast upwards. This was primarily driven by better than expected prospects for the US and China. The US economy in particular is holding up incredibly well. It's a different picture in Europe though. The Eurozone area is looking a lot less benign. Growth is expected to flatline for most of the first half of 2024. And actually just today, the ECB has also cut its growth forecast for 2024 from 1.2% to 0.8%, as the region continues to really face a number of challenges. Overall, though, analysts do anticipate a soft landing for the global economy, but downside risks certainly remain high. Let's take a look at our latest Scorable AI industry credit risk indicator for Q1 to see how credit risk is expected to develop across the various industries. For those who are joining us for the first time today, let me briefly explain how Scorable works. Scorable uses machine learning and explainable AI to predict rating upgrade and downgrade probabilities for more than 3,000 corporate and financial issuers across the globe within the next 12 months. The Scorable rating transition model analyzes more than 250 data variables every day. This includes, for instance, solvency ratios, capital requirements, profitability, etc. And based on this data, the model then provides a risk score and a relative value score, which allows investors to anticipate rating changes, to monitor risk in their portfolio, but also to identify opportunities ahead of the market. So when we look at our latest risk indicator report, we see that the consumer goods sector carries currently the highest aggregate downgrade risk at 22%. However, we have seen some improvements since the past quarter, namely household goods, household products, real estate, and apparel and textile. All those sectors have transitioned from the maximum risk bucket to the high risk category compared to our previous quarterly analysis. We've also seen an improvement for retail and food sectors. They have shifted from the high risk category to medium risk and now have an aggregate downgrade risk of 14% respectively. So in summary, we can say there have been slight improvements in credit risk across industries, but it remains a challenging environment for investors. Because if we look at the latest analysis on falling angels, it shows that there has been an increase in the risk of falling angels for both Europe and the US. In Europe, the percentage of BBB- issuers at risk of rating downgrade has increased from 18% to 19.4% since the past quarter. And in the US, we've seen a slight uptick from 16.7% to 17%. However, emerging market issuers have seen a slight improvement. So here, the risk of falling angels has dropped from 26.5% to 24.6%. It is a very nuanced and complex credit risk environment out there at the moment. We see shifts in credit risk across sectors and regions. So for investors, it is really crucial to stay ahead of the curve and look at credit risk and opportunities at the single issuer level. Because there's also a lot of opportunity in the market. Thanks to very attractive yields we're seeing, bonds are clearly back on the agenda of investors. Let's take a look at a real-life example of how Scorable can help investors anticipate changes in credit risk ahead of the market. Here you can see how our rating transition model predicted 2 rating changes for AB Electrolux many months before they actually occurred. In July 2022, our model signaled a downgrade probability of 38%, which is already fairly high. It then increased further to 65% by October 22. This is 6 months ahead of the actual rating action in March 23, when the issuer rating was lowered to BBB+ from A-. You can see in the chart that the downgrade probability remained high and then rose again to 43% in July 2023, which was followed by another one-notch downgrade to BBB in December. As you can see in the second chart, the spread started to widen at the end of October before the actual rating downgrade occurred in December. But our rating transition model signaled the increased downgrade risk many months in advance, and so gave investors valuable time to adjust their portfolios. Currently, our SRT model also detects a fairly high downgrade probability at 45%, which is signaling a very elevated credit risk. So further downgrades may well be on the horizon. To conclude, we think the outlook for 2024 remains uncertain, with many challenges ahead. It is a very volatile global political and economic environment, so it is crucial for investors to take a forward-looking approach to manage risk, but also identify valuable opportunities. Thank you for joining us today for the latest edition of bondIT Insights. If you have any questions or would like to schedule a demo of Scorable or find out more, please reach out to us. You can contact my colleagues, Andrew, Dan, David, or myself, either via our website or via LinkedIn. Thanks for your time and stay tuned for more insights and updates in the future.